out! Get out! I don't care what the price is, just sell it!
The mainstream financial media is currently obsessing over AI stocks and the illusion of a soft landing. Because, let's be honest, admitting the truth doesn't sell ad space on cable news, but behind closed doors, a massive structural rotation is happening. In February 2026, the US economy unexpectedly shed roughly 100,000 jobs. But don't worry, the politicians assure us everything is perfectly fine. The reality is, this signals the absolute end of the inflationary growth cycle. The elites are no longer playing for high returns, they are playing for survival. We are entering the post-inflation to deflation cycle, and institutional money is quietly fleeing the subsidized casino of the stock market into three very specific defensive asset classes. To understand what they are buying, you have to understand what they are running from. The global monetary architecture is fracturing. Unprecedented kinetic escalation in the Middle East has pushed Brent crude oil past $80 a barrel, threatening the Strait of Hormuz, which handles 20% of global daily oil consumption. Simultaneously, the BRICS alliance is actively accelerating its de-dollarization architecture. Foreign central banks are dumping US treasuries at a historic rate. In fact, the People's Bank of China just extended its aggressive gold buying streak to 16 consecutive months, hoarding an astonishing 74.22 million troy ounces. They aren't doing that because they like the shiny color. When the architects of the global economy start hoarding physical assets, retail investors need to stop looking at their 401ks and start paying attention. This brings us to asset number one, physical precious metals. We are not talking about retail investors buying a few commemorative coins. Leading commodity strategists are actively modeling a $6,000 gold shock for the 2026 to 2027 cycle. Why? Because central banks are preparing for the unthinkable, a severe monetary debasement. When fiat currencies lose their purchasing power, because governments can't stop printing money, gold operates as the ultimate non-counterparty asset. It cannot be defaulted on by a politician. Furthermore, institutional money is closely watching silver. Silver acts as a high beta monetary hedge, while simultaneously being an absolute industrial necessity for the global energy transition. The elites are not trading these metals. They are accumulating them to protect their baseline wealth from their own monetary policies. Asset number two exposes the greatest trap in the modern stock market: ultra-short-dated sovereign debt, specifically 1 month to 3 month US Treasury bills. Right now, retail investors are still desperately chasing high returns in tech stocks, completely ignoring the massive wealth trap, hidden within current S&P 500 valuations. Conversely, the elites have shifted their priority from return on capital to return of capital, because losing your yacht in a market crash is bad for the ego. With the benchmark US 10-year Treasury note trading below its 200-day moving average, macro models are flashing warning signs for long-term growth. By parking billions in short-term T-bills, institutional money locks in a guaranteed yield, while taking on zero duration risk. If the market crashes tomorrow, their capital is entirely liquid and protected, ready to buy up everyone else's distressed assets at the absolute bottom. Finally, asset number three, defensive real assets. As we rotate from an inflationary environment into a post-inflation deflation cycle, the elites are quietly hoarding assets with rigid, inelastic demand. This includes critical industrial metals like copper and uranium, energy sector equities, and defense contractors. We are witnessing an era of severe geopolitical kinetic escalation. When the Strait of Hormuz is threatened and supply chains fracture, the companies that control physical commodities and national defense systems hold absolute pricing power. Artificial intelligence cannot print a barrel of oil, and despite what Silicon Valley tells you, you cannot eat code. Smart money is analyzing these choke points and positioning their portfolio in hard, tangible reality. The global financial architecture is shifting faster than at any point since the 1970s. Understanding these institutional rotations is the only way to protect your purchasing power in the coming cycle. Please note, this video is strictly for informational and educational purposes only. I am not a financial advisor, and honestly, you probably shouldn't blindly trust anyone who claims to be one on the internet. Always consult with a licensed professional before making any portfolio decisions. If you want to stay ahead of the macro trends and understand how global geopolitics actually impacts your wealth, hit the subscribe button. We will be tracking the data every single week.